Welcome to the Opening Bell Report.
Okay, stop what you are doing. Seriously. If you are driving, keep your eyes on the road, but you need to hear this.
Oh.
I'm looking at a chart right now, and I've seen some crazy things in this market. You know, meme stocks, crypto pumps.
You're using your alert voice? I assume you are staring in disbelief at the Direct Digital Holdings chart.
Direct Digital Holdings, ticker symbol DRCT. Yes. I'm looking at the trading session from January 24, 2026, and I honestly have to, rub my eyes.
What are you seeing?
This stock, a regular listed company, exploded, plus 78%. 78% in one day.
It is a violent chart, and violence really is the right word for it. To put that in perspective for everyone listening, this isn't a stock like NVIDIA that's just had another good day.
No, not at all.
This isn't a victory lap. This is a stock that, until yesterday, looked like it was actively dying.
That's the hook here. That's why we're doing this deep dive. This thing has been bleeding out for months. I was looking before we started. It had dropped nearly 99% from its high.
99, wow.
It was trading around $2.30. I mean, left for dead. And then out of nowhere, boom, it rips upward to close at $4.11.
And that brings us to the core question, the one I know is on everyone's mind right now.
Is this the bottom?
Is the pain finally over for the shareholders who have watched their investment just evaporate?
Or is this the trap?
That is the tension. We need to figure out if this is a genuine recovery, a phoenix rising from the ashes, or if this is what we call a dead cat bounce.
I hate that visual, by the way. Cat.
It is graphic, but it's effective. It describes a sharp, fast rally in a dying asset that is, designed to suck in retail investors right before the price rolls over and heads to zero.
It traps the hopeful.
It does.
So today, our mission is to look under the hood of this massive move. We're going to analyze what traders are calling the green god candle, which sounds dramatic but fitting, and try to separate the technical squeeze from the fundamental reality.
And let me tell you, those seem to be two very different things right now.
They are worlds apart. And that's usually where people lose money, in that gap between the chart and the reality.
Mm-hmm.
So let's unpack the anatomy of this move first, because the numbers are just wild. You mentioned it closed at 411, but the way it got there.
Oh, it was even crazier. It wasn't a straight line up.
No.
No, it was a war zone. If you just look at the closing price, you miss the drama. So let's break down the mechanics. The stock closed the previous day around 2:30, right?
Right. Despair City.
But then it opens the next morning at $5.44.
Wait, pause there. That's a gap up of over 100% overnight.
Effectively, yes. Overnight, the sentiment or the order flow shifted so violently that the first trade of the day was more than double the previous close.
That is insane. So if you were holding this stock, miserable, you woke up, checked your phone, and your account had doubled before coffee.
Theoretically, yes. But here is where the psychology kicks in. Imagine you've been holding this bag for months, watching it go down 99%. Suddenly, you are up 100% on the day. What do you do?
I sell. I get out. I take the miracle and I run.
Exactly. And that's what happened. The selling pressure hit immediately. It dipped, and it dipped hard, all the way down to $3.58.
Ouch. So the people who bought at the open because of FOMO, they saw that gap, bought at 540 and immediately lost 30 or 40%.
Precisely. It flushed out the weak hands. It punished the chasers. But then, and this is the key technical signal, it didn't keep dropping.
It squeezed back up.
It squeezed back up.
Yeah.
It rallied into the close to finish at 411. The trading range was massive, from 358 to 604.
It's like a roller coaster nobody signed up for. So mechanically, what is happening here? Is this just a bunch of people suddenly realizing, hey, I actually love Direct Digital Holdings?
Probably not. If we look at the plumbing of the market, this has all the hallmarks of a technical breakout and a short squeeze.
Good.
You have to remember, this stock has been a goldmine for short sellers for a year.
And let's define that quickly. Short sellers are betting the stock goes down.
Right. They borrow the stock and sell it, hoping to buy it back cheaper. And since DRCT was down 99%, if you were betting against it, you were printing money.
It was the easiest trade on Wall Street.
It really was. You sell at 10, buy back at 5, sell at 5, buy back at 2.
But eventually, the party ends.
The rubber band stretches too far. There was a key resistance level around $2.50, when the stock gapped way above that.
Opening at 540.
Right. All those short sellers were suddenly underwater. They were losing money fast.
And to stop the bleeding, they have to buy the stock back.
Correct. They have to cover. And imagine a crowded theater with one exit door. Suddenly, someone yells, "Fire!" That's the price spiking.
Everyone rushes for the door.
Everyone rushes for the door at the same time. To get out of a short position, you must buy stock. So you have short sellers panic buying at the same time, speculators are jumping in.
And that creates a vacuum where the price just rips higher.
Exactly. It creates explosive fuel. It doesn't matter what the company does at that point. It's all about market positioning.
So it wasn't fundamental news, but the structure of the market itself, the short squeeze.
That's the most likely trigger. The easy money on the short side was gone, and the market decided it was time to clear them out.
Okay, so that explains the how, but let's talk about the why. Because even with a squeeze, there has to be some argument for buying, right? I want to play devil's advocate here. What's the bull case?
Well, if you want to wear the bull hat, your strongest argument is simply valuation. There is a concept called price for bankruptcy.
Meaning the market is assuming it's going to zero.
Right. The market is effectively saying, this business is dead. But if it isn't dead, if it simply survives, the repricing can be violent.
So what are we talking about here?
If we look at the price-to-sales ratio for DRCT, it's currently sitting between 0.1 and 0.2 times sales.
0.1. That's basically free. You're paying 10 cents for every dollar of revenue.
It is incredibly low. To put that in context, let's look at a peer, like PubMatic.
A healthy ad tech company.
Right. PubMatic trades at roughly 3.5 times sales.
So PubMatic is trading at a valuation nearly 35 times higher.
In terms of revenue multiple, yes, and that's the bull argument. They are saying, look, the gap is too wide. Even if DRCT is a worse company, is it 35 times worse?
Right.
If DRCT simply survives, shouldn't it trade at, say, 0.5 times sales? Or 1 time sales? Even that would be a 500 and 1,000% gain from the lows.
It's so bad it's good trade. Like finding a designer jacket in a thrift store bin.
In a way, it's also about mean reversion. You mentioned the stock dropped 99%.
Yeah, from over $80.
Statistically speaking, nothing goes down in a straight line forever without a bounce. A snapback rally was overdue.
Like holding a beach ball underwater. Eventually it has to pop up.
And we can't ignore the market cap physics. We are talking about a company with a market cap of around $59 million. That is tiny.
A micro cap. So it doesn't take billions of dollars to move it.
It takes very little buying pressure. A few large orders or a wave of retail excitement can move a stock that size 50 or 100% in a day. It's much harder to do that with Apple. DRCT is light.
So if I'm listening, I'm thinking.
Yeah.
It's cheap, it's tiny, it's hated, it's bouncing. This sounds like a lottery ticket that just paid off.
And here's where I have to play the role of the buzzkill. I have to be the designated driver at this party.
I had a feeling. You weren't going to let me enjoy the rally, were you?
Time for the fundamental reality check. We have to pivot from the hype to the actual business performance. Because stocks don't usually bottom just because they are cheap. They bottom when the business stops getting worse.
And let me guess, the business is getting worse.
Unfortunately, yes. If you look at the revenue, it hasn't just slowed down, it has collapsed. DRCT revenue is down 62% year over year.
Whoa, down 62%. That isn't a bad quarter. That is an existential crisis.
It's a collapse. Imagine you run a coffee shop and suddenly more than half your customers just disappear. And what makes it more concerning is the context.
You can't just blame the economy.
Exactly, because the competitors are doing fine. Look at PubMatic, look at Magnite. They are in the same storm, same industry, but they are actually growing, up 8 to 12%.
So everyone else is having drinks, and DRCT is in the corner on fire.
Essentially. And this brings us to a crucial analyst insight in our source stack. Stocks don't usually bottom when sales are getting cut in half. They bottom when the bleeding stops.
And right now, we haven't seen any evidence that the bleeding has stopped.
Not yet.
That is a tough pill to swallow. But what about cash? Can they just hunker down and save cash? Can they hibernate?
That's the other side of the bear case, the cash burn problem. This is where the insolvency risk comes from.
Insolvency. The B word. Bankruptcy.
It's the risk on the table, and it's why the stock is down 99%. Unlike PubMatic, which is a cash-generating machine, they pocket about 20 cents for every dollar of sales.
DRCT is losing money.
They are burning cash just to keep the lights on.
So they are shrinking rapidly, and they are paying for the privilege of shrinking.
And this is why the "it's cheap" argument is so dangerous. If a company burns through its cash, what happens?
They have to raise money, sell new shares.
Dilution, massive dilution. Or worse, if they can't raise money, they go under. Without a cash injection, that 0.1 price-to-sales ratio isn't a bargain. It's a warning sign.
That explains why there's no PE ratio support. I was looking for it. It just wasn't there.
You can't have a price-to-earnings ratio if you don't have earnings. Peers are trading at 35 to 45 times earnings because they have real profits. DRCT is trading purely on speculation.
Okay, so this is getting really interesting. We have these two completely contradictory narratives. On one hand, you have the green god candle, the short squeeze, the too cheap to ignore valuation.
The trader's narrative.
Right. And on the other hand, you have a business shedding revenue, burning cash and underperforming its competitors.
The investor's nightmare.
It's the classic battle between technicals and fundamentals. So what does this all mean? Let's get to the verdict. Is this the bottom?
The answer is nuanced, and I know people hate nuance, but it depends entirely on who you are. Are you a trader or are you an investor?
Okay, let's separate the tribes. Let's start with the trader, the person watching the charts minute by minute. Is this the bottom for them?
For the short-term trader, yes.
A hard yes.
A qualified yes. The technical momentum is undeniable. Breaking away from those $2 lows signals that the easy money on the short side is gone.
The trend has shifted, at least for now.
Exactly. If the volume holds up, we could easily see this squeeze continue. Momentum feeds on itself. If it broke 250 and held 4, $6 is not out of the question.
So if you're quick, there's opportunity.
There is. We give this a speculative score of 9 out of 10, high reward, but realize it comes with extreme volatility. You could lose 20% in an hour.
Okay, now let's talk to the other group.
Yeah.
The investors, the people who want to buy a stock and hold it for 3 years. Is this the bottom for them?
For the long-term investor, and no.
That's a pretty definitive no.
It has to be. This is a dangerous hold until the company proves it can stop that 62% revenue decline. A true fundamental bottom requires stabilization.
You can't build a portfolio on a company that is shrinking by half every year.
It's like trying to catch a falling knife, but the knife is also on fire.
That is a terrifying image. So safety score.
1 out of 10. High risk of dilution, high risk of insolvency. Do not put your retirement money in this. It is not the next Amazon. It is a distressed asset having a moment in the sun.
That is a stark contrast. 9 for speculation, 1 for safety. It really highlights how different those two games are.
They are completely different sports played in the same stadium. One is rugby, the other is chess.
So if someone's feeling brave or reckless and they decide to trade this, what's the game plan? What is the next step?
If you are trading this, rule number 1 is risk management. You need to keep your stop losses tight. I'd be looking at levels just below $3.50.
Why 350? That's specific.
Remember the setup? The stock dipped to $3.58 during the session before ripping higher. That level is now your floor. That is the line in the sand.
So if it crosses back below that.
If it breaks below $3.50, it means the buyers have exhausted themselves. The momentum is dead. You get out. You don't ask questions. You don't hope. You exit.
That's very specific, actionable advice. And what about the fundamental watchers? The people on the sidelines?
For them, ignore the daily price action. It's just noise. You need to watch the next earnings report.
And what are we looking for in that report?
We don't even need growth yet. We just need to see that the negative 62% has turned into, say, negative 10 or even flat. We need stabilization.
We need a tourniquet.
Exactly. If they don't show that the bleeding has stopped, any gains the stock makes now will likely just fade away.
It all comes back to the business eventually.
It always does. Gravity always wins.
You know, this brings up a thought for me. We often obsess over the ticker symbol, the price flashing on the screen.
We treat it like a scorecard.
Yeah, but sometimes the price recovers before the business does. The market tries to anticipate the turn.
That's true. It buys the rumor.
But, and here's where it gets tricky, sometimes the price recovers, and the business never does. The price is just a mirage.
That is the danger zone. And that's a great final thought. There is a profound difference between a stock's price and a company's value. Sometimes the price can run up on hope, on squeezes, but ultimately the business has to survive for that price to matter.
If the business goes to zero, the stock price eventually follows.
No matter how exciting the chart looked for one day in January.
A sobering thought to end on, but an important one. Direct Digital Holdings, DRCT. It's a rocket ship for now, but make sure you check the fuel gauge before you strap in.
Absolutely. Trade safe, everyone.
Don't forget to like, share, and subscribe for more.